What's up, everybody? Michael Silva here. We're going to be preparing for the next big catalyst taking place in today's stock market brief show. Make sure to hit that thumbs up if you haven't done so already. If you like this type of stuff, be sure to subscribe. Let's get into it. So, welcome back. As you all know, Powell came out today, and well, the market took it as, I'd say, pretty darn dovish. But what was really hidden within all of that? Why did the market rally? It's questions people have been asking. Honestly, who cares? But what you can see here is that the majority of all these headlines is all talking about Powell signaling that the rate is going to slow. Yeah, we knew that, actually. If you just look at the Fed Watch tool, we're still around that now 80% that we're going to be seeing a 50 basis point rate hike in December. 50 basis points, people, is still a rate increase. So be aware of that. And if you head out to June of next year, you can still see that the terminal rate is around that 5%. So despite that, the market still took off. But why did the market take off still? Well, there's a couple of factors that we can take into consideration. We've been already at that lower weekly expected move, and then we doodled around there, and then as soon as Powell came out and talked, boom, we exploded to the upside. Not only to the upside, we almost reached the upper weekly expected move in one single day, and that was some massive volume. Overall, we are still in a downtrend, a series of lower highs and lower lows. We're above that 200-day moving average. Oh, Nelly. Now, what else can be potentially why we're starting to see a rally? Well, always keep in mind seasonality, right? It's typically bullish. So we had month end. We were at the lower weekly month end markup, right? And then we have seasonality. And then on top of that, we had that lower weekly expected move. So we still got to be on guard because there are more catalysts coming. And we'll talk about how volatile the market is preparing for those via the expected moves. Now, if we take a look at what is on the calendar coming up, we have tomorrow, we got a new month. Welcome to December, holiday season. Here we go. We got ISM manufacturing PMI. We got personal income. But the big data drop here is on Friday. And Friday is going to bring the unemployment numbers. And that could get the markets moving. And I know it's going to get the market moving because of what I see in the expected moves, which we'll go over here momentarily. Now, as we're preparing for these catalysts to come, mainly the unemployment numbers and the jobs numbers, let's take a look at some very important aspects here. The VIX, Volatility Index, has been getting crushed, and it's coming into that interesting level down here around 19 to 20, where the last times we've gotten these rallies, boom, right here, and even right here, just right around there, you can see they took off from these levels. The VIX did, and that's where all these bear market rallies came to an end, and we saw big hits to the downside. So you got to understand that if you take a big look at this chart at VIX and you even go back further, we're still roughly at high volatile levels, okay? That is a little bit concerning. This pattern is known as the Cookie Monster. Moving on. Now, also interestingly enough, if you take a look at where the VIX closed at, right, it was at 2058. Today it dropped 1.31. So basically it was at 21, 22, 22, 20, 21, 22. On a daily percent basis, you're supposed to see, given that volatility, around let's just round it up, a 1.4% move. But today we saw more than a 2 sigma move here, a 3.1% move in the S&P 500. So yeah, volatility is still here, people. It's absolutely bonkers. Now, if we take a look at back month versus front month volatility, it would be nice to see this yellow line kind of press up a little bit higher to around 1.20 as the VIX comes down a little bit. The last time that has happened was also there in the middle of August, and that helped us mark that rally. The end of that rally. Very similarly, when the yellow line, the back month versus front month, comes down to around that 1% marker, and VIX is up here, that can mark the potential bottoms of rallies, bottoms of sell-offs, which we have seen. Now I'm going to be taking you into my Patreon a little bit. I'm going to give you an inside look of what these zones look like. We do a lot in the Patreon group. If you're not in it, you can join the community. It's inexpensive. It's $9 a month. And then you could do annually and you don't need to pay the monthly, and it ends up being like $90 US or something like that. We give weekly expected moves. We give trade ideas, zones, all kinds of stuff. I'm not going to talk too much about it, but I want to show you these zones because I've been kind of expanding on it recently. This was yesterday. This was yesterday's zones, and I'm going to update you, and I'm going to walk you through the entire zone file. A lot of white on the screen, right? These ranges here, they light up colors, and the range basically just tells you where price is, the closing price of these are within the low and the high of these zones, right? Within these bands. And as you can see here, we're basically around the midpoints all the way through, which we talked about that yesterday, that we're in some sort of contractionary period, okay? Well, now, one day, take a look what happened. So these are the updated zones. We're starting to get pretty red hot across the board. So prices, the closing price of these assets, the closing price is reaching the higher point of these bands. As you can see, they're lighting up red, right? So silver, Bitcoin, miners, and so forth. So we're getting a little frothy. Now, the reason why I'm showing you this is because if you remember back in, we had these zones updated for 11.14. So back at 11.14, which is right here, we were discussing that all this red was starting to take up the screen, and it wasn't just on these, it was on the S&P 100 as well. And as you can see, this is what happens typically. You can see the price came way up, right? Things got pretty red hot. And we said, okay, it doesn't necessarily mean it's going to crash down. That's not what it's saying, but it could come into a period of consolidation. It could pull back and so forth. It ends up being not the greatest position to, just push in long. And as you can see, during that period from that date, we just consolidated sideways. And that is when, obviously, all the ranges started to, clear itself off. And that's why I'm telling you now, we're back to getting a little bit of red hot right now, okay? Now, if we continue on, you can look at the S&P 100. I'm not going to show all 100 stocks, but I show that in the Patreon group. You can see they're also starting to light up red, meaning a lot of the stocks within the S&P 100 are obviously getting to those higher end of their zones. If we continue on and look at global ETFs, you can see here from basically Brazil down, you're seeing that these countries are getting very red hot. So we have, I'm not going to read them all up, but we got Brazil, we got India, Thailand, various emerging markets. We have China, right? So we're getting a lot of red hot signals here saying that, hey, could be a potential area where they're going to consolidate or they're going to be pulling back. And remember, on top of all of this, remember, this is all happening while volatility is coming into an important area, okay? And on top of that, it's coming into a Friday catalyst, okay? So these are all important aspects to take into consideration so you don't just FOMO yourself into a potential dud rally. Continue to go higher, but just, you got to be patient. You got to be patient. Now, if we take a look at commodities, some are lighting up red here too as well, such as silver, right? We already discussed silver. We have soybeans lighting up. We have coffee lighting up red. We have, what else do we got here? We got gold miners we already discussed, and then platinum. Okay, and then at the bottom here, we got AMLP, which has actually been pretty bullish all year. So actually, this could be a potential to add to AMLP. I'd have to check out the chart and kind of do that, but that one is green now. Now, if we go on and we even look at currencies, the currencies are coming to the bottom. We have BITI, so that's kind of interesting. We have, which by the way, BITI, if it's coming to the low end of the range, what's at the high end of the range? The opposite, it's BITO, right? So BITO, which is the ProShares Bitcoin strategy, is red hot, right? And that's basically because Bitcoin went, well, basically straight up for these last couple of trading days, which means short Bitcoin, right? Short Bitcoin Trust, which is BITI, is at the lower end. So this could be a potential opportunity right here too as well. Then we also have the Chinese currency here too as well, ticker symbol CYB, getting into the red. Let's take a look at fixed income, and you can see that this is, I love having these ranges here because it's just a quick visualization, but you can see that HYG, JNK, so high yield is reaching its high end, right? So this is interesting because they have a strong correlation to the S&P 500, right? So as you're starting to see the S&P 100, those assets, right, the larger market caps reach their high end of the range. You see junk is, you see HYG, or high yield is, then you also see TIP here too, tips as well. So that's something to, just pay attention to there. We have, what else do we got? Volatility, that's another one that I want to show. Volatility, so this is interesting. So VXN, it closed at still 26.46, so it's at the high end range of 20, right? a high end of 20, not too far from 30, which is, that's high volatility for that asset. And then we have RVX, which is Russell volatility. VXN is NASDAQ volatility. So RVX is at 16, which is at its lower range, and that's still in the mid 20s there too as well. Okay, so these are, you got to understand, volatility, it's still relatively high, and they're at the lower ranges of these zones. So Russell volatility, NASDAQ volatility. If you look at the VIX here, the VIX is, getting towards that lower range, and it's also coming into these prior areas of support of the Cookie Monster chart. So this is all should be taken into consideration leading up to a macro data drop, because the market has been incredibly dependent, right, on these macro data drops. And you can see as Powell comes and talks, the market goes all crazy, and there's just a bunch of narratives out there, but you gotta, try to hide from those a little bit and just see where everything lies at the bigger picture, so you can become a little bit more tactical in your trading. Now, I want to be very clear here that this does not necessarily mean that, we're going to just fall down or consolidate, right? These can go overextended for a while. We've seen it before, and we'll talk about that when we get into the S&P 500 chart momentarily, okay? One other thing here too, GVX, if you don't know what that is, that's gold volatility. Sorry, not GVX. GVZ, I got that confused because I looked at OVX. GVZ is gold volatility, and gold volatility is at 15.5, and we're starting to see gold on a pretty big rip to the upside. So this right here is pretty low volatility, and I think we should be keeping an eye on this and start looking at gold. As gold starts to try to come off a little bit, could be an opportunity to start buying some dips. So we'll continue to monitor that one too as well. A couple other things to pay attention to is the BP charts. We have negative divergences that are forming here on the BP chart. You can see we're back into 70.49 in the RSI. So we're moving into that overextended territory after today's price action. If you look at the broader market, even broader than the S&P 500, we'll look at the NYSE bullish percent index. And this is also in overextended territory, 71.46. Now, as we've stated prior, and we'll state it again, overextended could stay overextended for a while, but we'd like to see these divergences so you know how to, maybe consider position sizing differently, or being a little bit more aggressive with profits, or whatever the case is, however you trade, but you just can be aware that, hey, things are getting pretty hot right here, okay? And as you know, we go from overextended back down, and it just happens time and time and time again, okay? Now, let's continue on. Let's take a look at the 10-year yield. The 10-year yield backed off a little bit, all right, but not much. So after a huge move today, not too much action in the 10-year yield. So it did come off. It was up and then back down. It was down 1.2%. It's still at 3.7, right, or 37 here on the TNX. So I'm thinking that the jobs numbers can really send this for a move. So if the jobs numbers come in bad, perhaps we start moving up higher. We'll see. And if on the flip side of this, TLT gapped down to start the day, and then it started recovering, closing at the high. It closed up almost cent, and we're still here flooding around, consolidating in a overall down. Another big asset to watch is obviously the dollar. The dollar came off pretty good today, but it's overall still in this consolidation area. Honestly, it looks like it can just break down from here, and then this would shoot the S&P 500 up. But we'll see here. Like I said, there could be more volatility packed in these markets. We have a lot of things going on right now. It's been a very hard market to navigate, so you got to be very, very patient in these times. As you can see, the S&P 500 is still within this wedge pattern, right? Even despite today's big move. Right? So if the dollar wants to start coming back up, this is just going to take a back seat most likely. You can see it came down, and then the S&P 500 started ripping up higher. So continue to monitor that, see what takes place. On top of all of this stuff, let me fix this really quick. We showed these divergences between industrials and the transports, and surprisingly enough, even after today's rally on the transports, now this could change, but the transports did not put in that new high, and you can see the industrials clearly are continuing pressing higher. So there's still a divergence here, like there was right here in August. I think that this can change if we get some more continuation, but I found that to be pretty interesting. You pair that also with the negative divergence here on the BP chart for the Dow Jones Industrials. It could be just a big bull trap that's setting up, and we got to at least be prepared and aware of that so we don't just FOMO in at the worst time. If you take a look at this one too, housing, right, is putting in a negative divergence still too. So despite today's big move, did not put in a new high, and the S&P 500 clearly has been making that new high too. So the negative divergence there still stands. We've seen that happen a couple of times, like here, and here, and it led to sell-offs, but we're not too far off from breaking that divergence, so you don't need to put too much weight on that. Another interesting chart here is the percent of stocks above the 50-day moving average. We're at 92% of the stocks in the S&P 500 are above the 50-day moving average. So you look back to the left, right? You just look to the left and you're like, okay, when's the last time we were here? Oh, the last time we were here was actually back in August. And what happened then? Well, the bear market started rallying off. Now, this could be a positive sign because you're getting positive breath into the markets, but understand that these levels up here, they are a little frothy. And sometimes when they get frothy, they need to cool down by consolidating, by pulling back, or whatever the case may be there, okay? Now let's get into some bigger time charts. The bigger time charts are obviously we're in a new month, right? And we talked yesterday about how we're going to update these monthly expected moves. Just go ahead and screenshot it. If you're part of the Patreon group, I will be uploading the permalinks to these charts in the stock market indicators, so you can just always go and check via the link. By the way, I give all these stock market indicators in the Patreon group, okay? Now, the levels are right here. So the upside for the next month, for the new month, 4272. The downside is 388. Where did we finish? Well, we finished right here at about the dashed lines, by the way. Those are the quarterly expected moves. So right now we're above the quarterly expected move. And remember, 68% of the time, we close within the expected move. And we did finish within the monthly expected move. If you want to see last month's expected move, if you want to see that chart, go to my Twitter because I posted the charts there. So we'll continue to monitor and see how this goes, but this looks, I mean, if this wants to continue off into this direction, we have the 5 monthly period moving average starting to turn itself around. So that's, it's a positive sign so far. But if we want to get a bigger pump, that would bring us right into this prior area of support, and then support turned into resistance. So if we get up into that area, 4250, 4270, that area here, start looking at this level, even 4300 as a possible area of resistance in the next month. Now, if we take a look at the Qs is just closing there above that monthly 5 EMA as well. And you can see here, the upside move is to around 311.28. The downside move is to around 275. We are still within the quarterly expected move, which we have one more month to go. And it's leaving a lot of room for a lot of volatility, people, right? So we can still pump up here, and it's right by the monthly expected move, right around that 310 area. And then if we get some crazy something to happen, all the way down to 230 would still finish within the quarterly expected move. And if you're wondering, hey, but do these levels really work? Well, take a look here. This was last month in the Qs. And, you can go to my Twitter, and I posted each of the indices, like the IWM, the Qs, and the SPY. It came and touched the monthly expected move of last month to the T, and we rallied straight back up almost to the upper monthly expected move here. Now, keep in mind, right now, the Qs, we're still in bear market territory, that red shaded area, so we're still off 20% off the top right here. All I did was take this top line, and then we moved 20% down, and that brings us to right around this level. So we're still in bear market territory there. The S&P 500 is out of bear market territory. The IWM is right here, and we are still in bear market territory. The upper monthly expected move is 198 and some change, and that would bring us out of bear market territory, actually, in the IWM if we can get up there. The lower expected move is 176. And you can see as it stands right now, we're actually fluttering around that quarterly expected move. So is it going to play out like similar, how we're going to get some sort of rejection, or is it going to close within, the quarterly expected move? Remember, 68% of the time it does it. So it's a pretty high probability. But this has been a crazy year, right? A lot of crazy things have been happening. But those are the levels. If that's what I'm seeing on my screens, you can do it as well if you want. But let's take a look at one more thing here. This is where it's getting interesting. Going into the last chart, by the way, SPY. The SPY weekly expected move is on the screen, those dashed lines. You can see we tagged it and we moved up to basically the high end. This gray box right here is the remainder of the week. This is interesting because just take a look. We have 2 more trading days left. Okay, 2 more trading days left, and the expected move here still going into Friday is pretty large, right? It's about the same as it was at the start of the week. Now, understand that we've already had 3 trading days, including Jerome Powell already talking. Okay, so you would think that volatility would come off. Well, it hasn't, and we have 2 trading days left. Why is this? Why is there so much volatility right now? Well, it could be something to do with the jobs report, and the market is just on pins and needles on these market data drops. So it's important to understand this. Remember, the expected move for yesterday, we've already discussed, we had a 2 sigma move, right? So the volatility is here, but overall, we're still within the weekly expected move, which 68% of the time, right? Based off of just bell curve, 68% of the time, one standard deviation, we finish within it. Okay, so if we are going to close within the weekly expected move, okay, that'd be below 410 or above 395. Okay, but we also have this to pay attention to. These levels are this gray box. That is what's expected as of right now going into the last 2 trading days. So people, there's a lot of volatility, okay? So be aware of that in your trading sessions. These trading sessions have been wild, okay? So intraday trading, you got to be very tactical. Even swing trading, you got to be tactical. Now, overall, when I look at the SPY, I mean, this looks bullish, okay? People, it does. Yeah, you get above that 200-day, whatever. And then price action is kind of like breaking through this consolidation that we talked about, the chop box. So now we got to see if we can get some follow through. And then if we get follow through, look for a pullback or look for a pullback, and then we get some follow through. And then that could set us up for potential a little bit more confidence. But be aware where we stand within all the zones, which we already previously discussed. Be aware of where volatility stands. Be aware that it was month end, okay? Be aware that we have macro data drops. Be aware of the overall trend in the markets. Be aware that the Fed is still raising rates. That's all I got for today's video, everybody. Goodbye.